So we built this property for $33 million. Today it's worth over $60 million in just 7 years. You know what's even better? Over 100,000 cash flow a month. So this is the math of the deal.
Riverwalk Apartments is 210 units. We started the development back in 2010. We actually started construction in 2016 using a $20 million construction loan plus $13 million in investment equity. And the total of that is $33 million. We built it, finished it in about 17, got it leased up, refinanced it in 2019 for $33 million.
So at this point, we are infinite. So in other words, this 33, which is a cash out refi, which is a new debt, pays off the original 20 plus the investor. At that point, the investors are not in the deal anymore.
So the investors have zero investment, so whatever return comes out of here is infinite.
Now, of course, we have this interest rate at 3.03, which is a $33 million loan. So even though we have close to $30 million in equity, we would have to give up this 3.03 loan, which we don't want to do.
We don't want to do. Right.
So we'll keep this in place, and hopefully our equity just continues to grow. But we could do another cash out refi because we're about 50% loan to value. We're cash flowing about 1.2 a year, or about 100,000 a month is what this property is doing right now. So right now it's doing 100,000 a month, or 1.2 million in open free cash flow with zero investment. And we got about 30 million in equity. So this is one of those assets that you just keep. Hopefully if rates come down again, then perhaps, we'll try to scoop another 10 or 15 million and distribute it to the investors. Again, tax free, because it's a debt. You don't pay tax on debt. If we sell the project, we have a lot of tax.
One of the things that you get from investment in real estate, in addition to the cash flow, is what's known as depreciation. And depreciation is a non-cash loss that the IRS lets you take based on the value of the building. And it's approximately, I don't know what it is, but probably a couple $1,000,000 a year on this. If we have $2 million of depreciation on this asset every year, and we have $1.2 million in cash flow, we have $2 million in depreciation losses. That means, for tax purposes, the deal's losing $800,000 a year.
So the cool part is the investor gets $100,000 a month, but their K1, which is what we report to them, the partnership actually reports an $800,000 loss. So they get cash flow, but they report a loss on their tax return, and they can use this to offset other income in other ways. Mm-hmm. So that's depreciation, and so the IRS gives apartments 27 and a half years depreciation schedule. So you use that against your cash flow, and that's a big reason why people invest. What they want is the cash flow, and they don't want to pay tax on it.
We can use other techniques such as cost segregations and bonus depreciation to further increase that tax benefit.
And this is precisely why you should hold real estate. This is precisely why we don't want to build it and then sell it, because we'll have a huge tax problem. And by the way, you'll get all of these tax benefits the minute you sell. This is called recapture. So all the stuff recaptures. So you actually have to pay tax on all those years of savings during that time. So this is really a tax deferral more than anything else. But it's legal, and it's exactly why most people keep real estate for the long term. The interesting thing is that most people don't buy real estate to hold.
Right.
The majority, because they get all caught up in the equity, we know we have 30 million in equity in Riverwalk, and of course that would suit Ross and I. If we sold it, we'd get that cash plus our investors. But then what do? You put it in the bank, you give it to a wealth manager, and you try to generate cash flow again. It's going to go somewhere. And so you're better off to keep it here and take advantage of the built-in tax benefits that you have for holding real estate long term. So this deal, Riverwalk, is of course on our portal for all our investors to see, as it was when they invested in the $13 million, as is the rest of our deals. So if you guys are interested in taking a look at more deals like this, they're on our portal. Just go click on the link below. Can you imagine being able to build something like this today for $33 million? Today this would cost
200 units cost $50 million.
$50 million today, so that's why you let inflation work for you.
It always looks expensive when you're doing it.
Then 10 years later, you're like, I'm a genius. How many times have we done that?
Every time.
I remember the first building we bought, 9.7 million.
Yeah.
We still own it.
We still own it.
182 units. What do you think that's worth?
$36 million.
Yeah, so I don't know. I'm not good at math, but I think that's good. So we have a saying that the bigger the brochure, the worse the deal. Right?
Yeah.
So because if you have to put together a big package and try to sell somebody on it, then it's probably not great. Most of our deals are done on the back of a napkin. Literally, that's how it starts. It's just like, okay, like Ross, he understands construction costs. So he's like, okay, 20 million, we need 13 of equity. And then of course you try to figure out what the value is afterwards, based on the expenses, based on the rents.
Right. And Ken can identify the rents, and he knows how much the expenses should be on 200 units. We can make a decision.
Get very close.
Whether we should pursue the project or not.
And by the way, we still could be wrong.
Yeah, sure.
That's the important thing to understand. But if it pencils like that, then it goes to the next level.
Yeah.
Which means that's when it actually we fine tune it.
So we don't actually stop at the back of the napkin.
We've never raised money on a napkin. We always put it in a business plan. But the business plan flushes out things that maybe we didn't think about. And depending on what beer we're on.
What did we not think about?
So there's things you don't think about, but mostly at this point with 75 years of experience, it's a lot of banter. More than anything. Like, what about this? What about that? What about this? What about that? And we just start to fine tune what the deal is. And then from there, we either shit can it, throw it in the trash, or we go, this is worth pursuing and taking a look at a little deeper. And that second phase, it might die there.
It can die in many deaths.
Yeah, it can die like we might not get the density here. Maybe the rents are off. Maybe the expenses are higher. Maybe the lender won't lend. Maybe the interest rates go up. Maybe the loan to value's low. Like there's so many things that can kill a deal. There's huge risks in this business.
We go into every deal saying with the ability to say no. So we have to convince ourselves, and then we have to convince our management team, or they have to convince us whether we should do it or not. Because we've never lost money saying no.
Right.
We've maybe lost opportunities, but there's always another opportunity around the block if you're ready for it.
It also is good. You find especially hard-driven entrepreneurs, they just want to do deals a lot of times. And our employees are that way, and that's kind of the way they're built. We're in the business to do deals. So when Ross and I are saying no all the time, it can be frustrating if you work for us, especially when we have a 20-year history of raising money on doing any deal we want. And then we start saying no for 2 years, I think. It can be frustrating to an employee. You don't want to take 20 years of experience and a good track record, good returns to our investors, and put it on the line for just to keep buying in a 2-year period. That's really the big issue.
We like to say we shoot for singles and doubles and not home runs.
So most people go for home runs. Ross and I, we try to just go for singles and doubles. And what happens is a project like this ends up being a home run. But we never think it's going to be a single. And that's what happens. You got to be super conservative on the business plan.
You're conservative and you're minimizing losses. You're providing consistent returns that keeps your investors coming back.
Ooh, looks familiar. Well, I think that's an important thing to bring up. And we talked about it before when we were at Silverbell. What happens is the residents tell you by which floor plans they rent. They also tell you what they like in the floor plan. And the management tells you what rents, what doesn't rent. It all is driven by the consumer. As a developer, we always try to modify the floor plan and change things based on what residents want. We found that this floor plan, the Silverbell floor plan, just works. So why reinvent the wheel each and every time?
This property leased at 20 units a month and is done extraordinarily well and we've been able to raise rents. We save a huge amount of money on design costs, and we get a product that we know works. Why, exactly like Ken says, why reinvent the wheel?
So you go back to the original architect and you say, we want Riverwalk product on the Silverbell site. Then they figure out how to put the Riverwalk product, which is where we're at now, on the Silverbell site. And then that tells you how many units you can get.
Right.
And so you save a lot of time because you already know these units work. And of course, it's across town. A consumer's not going to know that these are the same units that we know.
And you tweak it. Times change and taste change. You'll notice that we have an overmount sink instead of an undermount here. We have black appliances. We have not quite the same lighting fixtures. We don't have LEDs in all these. So there's some things that just happen that we adjust to based on what the consumer tells us they want.
The key is the consumer. You always try to deliver what the tenant wants.
And if we don't change the design, we know how to bid it.
Yeah, that's another really good point. Right. Obviously, we know the price point of this unit across town, and so that's super helpful for trying to figure out what your numbers are going to be at the end. The point is this is the exact same 2-bedroom that we built across town. The rents are $1,900, and over here they're $2,200. Correct. Yes. So $300 more, same floor plan, better location. Mm-hmm. I think that's important, really important, especially if you have 100 of these. So which we do. That's 100 plus another 300 each month. That's why location is so important. So sometimes you can stretch on the site and actually pay more for the site when you get higher rents, even though you saw the floor plans are the exact same. So this is retention. So you can't build here. So you do things like this, and then you allow dogs. And so the tenants can come down and let their dogs out in here in an area that you couldn't do anything with anyway. So we do this at all of our projects across the country. You got to be pet friendly in this business, in my opinion, and we are. So that what we decided to do, embrace, gosh, it's probably 10 years ago, Ross, that we decided to embrace being pet friendly for the whole company. And so it's just a matter of, you can do different stuff like hard surfaces on the floor instead of carpet. There's things, because pets, there's damage with pets. So you just build it or renovate it accordingly so that it's minimized. But if you're a pet owner, you're probably going to get shot down at most apartment properties because a lot of them don't take pets or they charge really hefty deposits. So you're better off just to embrace it and come up with really good policies, and then your occupancy wins, it's up, and your cash flow's up, tenants are happy.
It's good for retention too. Yeah. People aren't going to leave if you're nice to their dog.
Yep, that's right. This is that handmade retention, that wall that John was talking about at lunch. Right, John? This is your handmade wall? I tell you what, we thought John was on PTO, but this is how he spent his time right here. Look at this wall, all hand built, just like the pyramids.
Correct me if I'm wrong, but you got like a layer every foot or 18 inches?
Every 18 inches.
There's a layer
a piece of geocloth. You can see some of it in between the layers. It's like a black checkered cloth.
Yep, I see it.
And that goes out about 10 feet, and it gets backfilled over to the top of the next layer of stone. Then it gets another layer. So it's basically what we call a gravity retaining wall. The weight of the soil on the top half of the thing is holding it up. And because it's so porous, you don't have to worry about drainage on these things. It drains itself. Masonry retaining walls, you got to be really careful about getting the right kind of drainage behind them because they can build up hydrostatic pressure. And I've lost them.
So that's why it's loose rock.
Yep.
Okay, so the water flows right through it.
It can go right through it.
Huh.
And that goes down to the
river?
The bicycle trail, yeah.
What a project. Every time. When I come, I don't come down here this part as much, but I'm like, it's where I would hang out.
I would be happy to live here. I was going to challenge you to go sit on the purple couch.
Yeah. Hey, I got in the pool yesterday, and twice a year I like to scrub the inside of the tiles, make sure they're fresh looking, and gets a calcium.
It looks great. The pool looks fantastic.
It looks great. Can't believe it's 7 years old.
It's not a bad job, like putting your suit on and getting in the pool.
Getting in the pool. Hot summer.
No wonder we have such clean tiles.
Yeah, oh yeah. For some reason, all our pools are crystal clean.
Yeah, good.
Come on, partner. So every deal that we buy or build, it always starts with a story, right?
Right.
So let's tell the story about Riverwalk.
This site is part of a master plan, as you can tell. There's this development of the natural grocers and doctor's offices and the self-storage.
Basis, Whole Foods across the
Basis
street.
of Whole Foods, and that's all part of the master plan of the community. We started working with the developer of the master plan in 2010 to purchase the property from them. It was extraordinarily difficult because of the topography, the design, trying to figure out how we were going to work inside, the restraint, their soils conditions. We're on the bank of the Rito River. There's retention and detention issues, as well as setbacks and 100 things that we had to resolve before we could get this under contract and get it built. 2010, and we didn't start building it till 2016.
Sometimes, though, that's not that unusual. I know it sounds like a lot.
Well, Savannah Springs, for one, was 9.5 years.
We're playing the long game here, right? Mm-hmm. Like, you start working on sites, and it could take years before you get it under contract and figure out if you even want them.
It's an extraordinary location. It's at the base of the Catalina foothills in Tucson. It's on the Craycroft Road, which is a major north-south arterial all the way from the foothills to all the employment centers in Tucson, including downtown University, the hospitals, Raytheon, airport.
Yeah, apartments have what we call a walkability score.
Yeah.
And walkability means the proximity to other things. And this has extremely high walkability.
Yeah.
Because you can basically go shopping, you can walk there, literally.
There's 6 restaurants within 1 block of here.
When somebody's looking where they want to live, work, play, all in one kind of spot, this is highly desirable. If we listed this property, because it's highly occupied at all times, it would sell very quickly. That's why you want to keep it, because it's doing over $1 million a month in net cash flow, and that's after a cash out refi.
Maybe $100,000 a month, $1 million a year.
It's doing over $1 million a year. That's after a cash out refi that we already did. So we already returned the majority of the capital back to the investors. We
Right.
still have some left, but it's cash flowing like crazy. So you don't sell stuff like this, because this is kind of the whole point.
This is extraordinarily good real estate here from a location point of view, as well as the design and functionality of it. It's really great.
One thing to notice here is some of these are 3-story, and some of the projects were 1-story, many are 2,
Right.
and in some cases you've got 3. So different kind of a design, but you can increase the amount of units per acre if you're able to do 3-story.
Well, and you can see too that because it's 3-story, it's much more open site than if it was not 3-story. So we were able to get the density we need to develop it economically, have a nice product that is comfortable to live in.
So one thing to point out that's probably may or may not be obvious, but if you look here, Josh, you'll see that all the units on that side, all the units on this side, when you are renting to people, those would be premiums, because they're not looking into anything other than nature, right? They're looking at the mountains, they're looking at the wash, they're looking at all the wildlife and everything down below. As you're picking out a site, you're thinking about those kinds of things, because you're always going to get premium when the views are amazing. And this is certainly one of those situations.
Exactly like our projections were, although our rental rates were more than what we had projected.
200 units at the time.
Yeah, 210.
210 at 33 million.
People ask me, how can I do this? And I really don't have an answer. We got this site. Everybody wanted this site. And we got this site because I had a relationship with the seller that was 30 plus years long. And we were able to work together. He and I worked very closely together for that whole 6 long years that we needed to have to be able to get this, everything entitled. That takes extraordinary patience. By the way, by the time we got it closed, I think we had in excess of $1 million of our own money. The capital to do the pre-development costs, and you need to have the understanding of what it takes to get the project done, and you have to have the relationship to get people to work with you. And that takes just time.
And I think the other thing that a lot of people don't understand when they look at something like this is before we actually get a bank loan to build the project, before we put a package out to the investor, how much money would we have out of this project?
Every bit of $1 million.
Yeah, easily.
We pay for all the architecture. We have to have all the engineering. We have to have deposits on, all the consultants, appraisals.
And that's not money you raise coming out of our pocket.
So we're at risk for that if the deal
$1 million, not including the cost of the land, right?
Right.
Yeah, so all of those costs are up front. You have to have the land, you have to have all that stuff figured out before you can go to the bank. And then the bank says, this is what we'll give you to build on the construction loan. And then the balance is the equity. So that's essentially how it works. The equity is the very last thing. You never know what the equity is until basically the 11th hour. Right?
Right.
So all that other stuff is years long. So you got to have faith in what you're doing in the process. And then only after you get the construction quote from the bank, from the lender, then you actually put the package out for the investor. And that's when you know exactly how much you're going to need to able to complete the project.
And that's what it takes, all the risk for the investor, or as much of the risk as you can possibly remove.
Is to do all of those things first. And then the only thing left is the equity. And a lot of people do the opposite. They'll raise money and then they'll go out and try to do this. And then that, of course, doesn't always, it's not a straight line. When the line goes sideways, we put all our money up, we get the land, and then we go to the bank to get the debt quote. And then only then do we know how much equity we need. We put that into a business plan, and that's when we raise the money. Thousands of things that go wrong from the day you start. Almost every week, every couple of weeks, there's something. Every single project.
So what would you say to those people who just say, well, it's going to be super easy, just go raise a few $1 million, go find a property, and you're rich, and you have a bunch of passive income?
Well,
I'd say
next.
I'd say they're not telling you the truth.
Yeah, it just isn't the case on anything.
This is not a passive business. I mean, yeah, you get passive income, but there's nothing about this is passive.
It's full contact.
Yeah.
Until the end, right?
Yeah.
This stuff is full contact.
From the time you identify the site, then the fund starts, then you got to put people in it, then you got to service them, then you got to pay the expenses, then you got to make enough income to pay the expenses as they increase and do all that. I mean, this is hands-on hard work.
You got several hundred people here while it's being built.
Yeah.
And then after they all leave, you got several hundred people here living. And you got to manage that. And while they're both are going on, you got to manage that. You got to go to the bank and you're trying to get out from behind that construction loan. So don't forget, these construction loans, they're personal guarantees.
And they're all short-term.
Yeah, which means that we have a 3-year window to be able to build the project. And Ross and I have a personal guarantee on the loan. To build this project, we owe personally. That's a really important thing. Yeah. This is a full recourse loan, like all construction is.
We have to really believe we can do this. Personal guarantee is personal guarantee.
Yeah, everybody needs to be concerned about those. And that's actually what takes down a lot of people, is personal guarantees. If you think about it, you can build 20, 30, 40, $50 million in net worth in a cycle, and you can lose it all at the end with personal guarantees, right?
Right.
Easily. I've seen it happen a lot with friends of mine. Plenty of people are on the hook now. Short-term bridge loans, anything floating, personal guarantees. That's when the contracts come out with the lender. The lender's pulling those agreements out right now. And that's why you start to see people selling, all those cars that they post on TikTok and all that crap. Like, you know what I mean?
Right.
You're starting to see all that stuff happen. You're starting to see more assets. That's part of the reason why asset prices are dropping, because people are having to sell their stuff. And that's a good time to buy.
Yeah.
And so now, how is your process from stepping on the brakes for the past few years to now you're seeing this distress? So how are you playing?
Well, I think the people that were living in the fast lane are crashing right now.
Yeah.
So you just go clean up their mess. And, it's just a matter of time.
We're identifying the resources that will enable us to take advantage of other people's mistakes.
Yep. Inexperienced or have raised a bunch of money and doing projects and overpaying and all those things like they did, that has a way of working itself out. So it's just working itself out now. And then that's when, to be honest, we're not the only ones that are doing this. There's a lot of friends of ours.
Doing it.
Yeah, there's a lot of people that are sat back and they're just kind of waiting for all call it the first-time amateurs are taking a tumble.
So there are good quality assets that are going to come out of this. The key is to be able to identify those and be patient and have the wherewithal to act when it comes time to act.
For all first-time investors that are just now looking to get into the market, it's just math.
Yeah.
At the end of this, it's 100% math. It's what do you pay, what's the cash flow, and how much are you putting in? That's it. So everything is math-based. And what happens is people start to compromise based on, I think this is going to be worth a lot more next year or the year after. That's when people get in trouble.
That's a really good segue into this. When we evaluate a new construction project, we evaluate it for cash flow. We don't evaluate it for an exit at some finite time and assuming we're going to make some kind of gain on it. We evaluate it for cash flow. Because if you can get the cash flow, then everything else is okay. I mean, you can pay your bills. You can keep your people on the job. So we always look for cash flow first and look at capital events, part of a secondary analysis.
We know that we have $30 million of equity in this project. That's clear. That might go up, it might go down. But what we really know, we have $100,000 a month of cash flow. If you sell it, you all of a sudden don't have that over $1 million of cash flow a year. And of course you have that $30 million of equity, but then you pay tax on that. And then you're just trying to redeploy that back into the market. So the real thing to watch is how much cash flow do you have at all times? And so Ross is right. When we do this, we don't do it like a big flip. We don't do it with a predefined exit. Yes, we can get that equity and that would be amazing, but we actually want the cash flow. That's what we want. A lot of cash flow so we can continue to do this. And then it just continues to compound. And if we ever need it, we got it.
Well, an infinite return is when you are getting cash flow and you have no net investment. In this particular example, we raised $13.5 million and borrowed $20 million from a bank. We built the project. We got it leased up. We were able to get a new loan for $33 million, 3.03%, fixed for 10 years. All our investors, in essence, got all their money back, but are still seeing $1 million a year in cash flow.
So you pay off $33 million loan, which is a cash out refi. The first thing you pay off is the $20 million that it cost to build it. Then you pay the 13 to the investors that they gave you the money to do the deal. And at that point, there's zero. And so from an investor standpoint, Why would you want to sell something if you have zero investment and you're getting over $1 million of cash flow a year? We rarely get calls from investors that say, I want my equity.
Yeah.
What they want is that monthly check. And that's the difference. They want a monthly check. They know that we always have the equity. It's like, why would you walk away from that monthly cash flow? Because that's what everybody's missing, is they want that cash flow.
A friend of mine calls it a storehouse of value.
So the best real estate deals always have one thing in common, as well as any deal that Ross and I have ever done. If you want to find out what that secret is, watch this video here.